episode 72 of Top of Mind with Hao and Chris. Today is Friday, June 13th, Friday the 13th, and it's after market close and we are recording today. And on today's episode, we are going to be talking about who's right, bonds versus stocks.
And then CPI, it's tame for now.
Yeah, CPI just came out.
Inflation.
Normal.
Yep.
And the final one just hit the news here really recently. Stablecoin offerings from Amazon and Walmart? Question mark. All the big credit cards.
Yeah.
Can they do it? Can they do it? Will it make any difference? All the big credit card companies, Visa, MasterCard, Amex, Square, Block, which is now XYZ, all sold off with that news. So we will give you our thoughts on that one. All right, let's get into it. So who's right, bonds versus stocks? I want to turn it over to you, Hao. So just to give a little backstory, what happened during and after Liberation Day was something that was not normal. And what happened is that stocks fell and bonds yields went up, which means the value of bonds went down. So stocks fell and the value of bonds went down. That normally doesn't happen. Normally stocks fall, yields fall, which means the underlying value of bonds goes up. It's one of the reasons why you own bonds in your portfolio, because it generally has an inverse relationship to stocks, which is a nice dampening effect during periods of volatility. That didn't happen. In fact, yields went up. And then you all probably saw in the news not too long ago, mortgage rates back at all-time highs. And so we thought that now that we have a little bit more data, and a lot of these tariffs have been paused, kind of starting to get some negotiations. I think the market will probably see something more acceptable, I think, come out of all of this versus what was announced on Liberation Day, which was so much more dramatic than what the market was pricing in, which hence the sell-off. So we just have more data and more time. We thought we would unpack what the bond market is signaling, because stocks have basically ignored all this. Stocks are up. Stocks are sitting at all-time highs again. Microsoft touched an all-time high the other day. So, however to you, I think let's just unpack what's going on in bonds and why this is important, because I think no one's really looking at this, right? We all just look at stocks.
Yeah, the bond market's boring. Why do we need to look at that?
Exactly. Simple, yeah.
Well, again, bonds, let's just look at U.S. Treasuries, because there's the truth to them, right? Meaning, debt levels aside, it means you can measure a bond's price based on what the interest rate it pays you versus what you can get on the open market with either a higher or lower interest rate, right? And generally, if you think about it, you're lending money to someone when you're buying a bond. And as the lender, given this, everyone's the same credit quality, what do you want, right?
Just want to get paid back.
You want to get paid back first and foremost. You probably want the highest possible interest rate for lending out that money. And that's really the
reasonable.
Yeah, that's probably the most basic form of bond investing. Is think about it, you're lending someone money. That's really it. And the U.S. Treasury has kind of been the world's borrower, if that makes sense. And we've talked about this ad nauseum. Most of the outstanding U.S. bond debt holders are U.S. citizens, about 66% of them. Mm-hmm. The remaining, other countries. So I think the bond market is another place to potentially signal its intentions. What does it think about inflation? What does it think about the debt level? What does it think about a particular country's credit rating or credit risk, right? We talked about Argentinian bonds paying 85%, right? What are you picking up with that? I'm using that, an extreme example, to just really point out that you got those considerations baked into that 85% payment because Argentina was going through hyperinflation and they have pretty bad credit. So the likelihood of getting your money back is pretty low, or lower than, say, a U.S. bond. That's why they have to pay 85% on their debt. I don't know what it is now, but I'm just using that as an example from I think it was 2 years ago when they had the hyperinflation. So what the bond market now is signaling, 4.5% on the 10-year Treasury, which has this knock-on effect to 30-year fixed mortgages, right? We want the 10-year to go down for the mortgage rates to go down. Mm-hmm. But we started the year at 4%. Now it's 4.5. It touched 4.9 at the whole, tippy top of the Liberation Day drama. So what the bond market was signaling at the stock market bottom was the U.S. is something to worry about. The debt levels are high, inflation's high, and tariffs are most likely going to drive prices up. And therefore, 4% isn't enough for me to invest for 10 years because I'm going to lose money. That's all we're saying, right? Mm-hmm. I know I said a lot of world-changing things, but that's really the basics of it. So when the bond market says, I need 4.5% to lend you money for 10 years, it's saying something. Over the next 10 years, if 4.5% isn't enough, right, I think inflation is going to be higher on average over those next 10 years. Because why would I invest in something that doesn't beat inflation, especially if I'm locking in that much?
Well, because you think inflation is going to come down. That's one theory.
Yeah. And the other part is, what's the credit quality of who I'm lending to? Is there a chance that they don't pay me back, even if it's an off chance? In the off chance, there's a truth to it, right? Let's say there's a 10% chance of default. There's a way to mathematically price that in. And that's what I meant by the bond market has certain truths to it. Does that make sense? Mm-hmm. So if you as a borrower default, do I lose my $100 loan to you? Maybe. Or I can rightfully capture whatever value you do have left. Let's say you borrowed the $100 for a car. I can take the car back and probably sell it for $60, right? So it's not a total loss in a lot of sense when someone defaults on a loan, because there's underlying assets that have been bought with that borrowing. So that's called a recovery rate, right? And that's built into the bond price as well. What I'm saying is all those different components that I brought up, something in there is registering higher risk. And the bond market's saying we do not want to take less risk by accepting a 3% yield on 10 years.
Which pushes yields up, right?
Yeah.
You have a stat in here about Treasury demand. And so something that we've enjoyed in the U.S. for many, many years is we have a lot more demand in the room for the supply that we are issuing. So I'll read this here just as an example. So demand at recent Treasury auctions has shown a clear divergence between shorter and longer maturities. However, the June 11th auction for $39 billion, so the Treasury auction.
The most recent one this week, yeah.
So this week. So June 11th auction for $39 billion in 10-year notes saw robust demand, with bids outstripping supply by more than 2.5 times, which is historically about average, right? That's normally what we see. And a low primary dealer takedown. I don't know what that means. Indicating strong investor participation beyond just the recent buyers. So the previous line here says that recent auctions have been notably weak. Is that in other durations? Or because the 10 years, as you just said, that's the gold standard, right? And so we just issued 10-year bonds. We have plenty of demand. Feels good, right?
Yeah.
What am I missing?
So recent Treasury auction. So this happens every week. I believe it was 2 weeks ago where that 2.5 times. So every dollar available to buy in Treasury bonds, there's $2.50 of demand wanting those bonds.
Yeah.
Which is actually awesome. 2 weeks ago, it was 2.46. Doesn't sound like a huge difference, but that's what spooked the market back then, because suddenly 0.4 drop, that translates to billions of dollars. So that that's something that can scare, especially the bond market. And that's where we saw, at least temporarily, higher 10-year yields because the U.S. has to raise the interest rates to induce more buyers. So if this becomes 1-to-1, that probably won't ever happen. But if it becomes 1-to-1, they would just have to keep raising the rate on those bonds for buyers to accept that particular bond.
Yeah, I got you. Okay. But the thing is, there's still something wrong. Because
there's something wrong. Yes.
Historically, we've enjoyed 2.5 times roughly, but rates aren't going down. Why are rates stuck? Like, rates are stuck.
Yeah.
The Fed's lowered rates a little bit. We know that controls the very, very short end of the yield curve. So your high yield savings accounts, your money markets, that kind of stuff. Mortgages are pretty much sitting at all-time highs. Yet we have standard demand for our debt. So, like, why aren't rates coming down?
Yeah.
Inflation's going down, right? Inflation's low. Everything else is looking good, right? Why aren't rates coming down?
So I think the explanation that smart money, I use air quotes, say about this divergence when the bond market isn't doing what it's supposed to be doing, they call that bond vigilantism, meaning the normal bond buyers are stepping out of the market, purposely pushing up rates to prove a point, which I think is one of the, I don't believe it, but if I were going to humor that explanation, they're seeing something either with the level of U.S. debt, and it probably isn't a coincidence when that big, beautiful bill passed the House, and it showed like a $300 billion yearly deficit in addition to what we're already in a deficit spending year in, year out. They increased the deficit, and you saw interest rates on the 10-year go up. So it's either combination of reaction to fiscal spending, which in my opinion is pretty irresponsible, right? You cut rates, you don't cut corresponding spending, and you put yourself in a bigger deficit, but you have all this debt to pay back. Your credit quality should come down because you're spending more, but you're making less. Right?
What do you think the spending bill has to do with all this? Is that why rates are stuck?
That could be it. So remember that off chance that you don't pay me back for my loan, even if it's a small chance, that has to be priced into the bonds. And then therefore that has to be priced into the interest rate that the borrower needs to pay in return for their declining credit quality, right? Same thing with any kind of loan. If a lender sees that you're jumping from job to job, or you have higher spending than you take in income, you probably wouldn't get the loan. But let's say you always get approved for a loan because you're the U.S. You suddenly have to pay more because no one wants to take on that perceived risk.
I was just looking up here on the side here. So the spending bill is targeting a July 4th deadline to pass, and it's not guaranteed to pass, but it looks like it's actually likely to pass. Now, some things might get changed, but that's been said to run the U.S. into further deficits and add to the national debt.
Yes.
I think at least most reports kind of point to that or agree on that. I wonder if that's what's holding out, right? I mean, July 4th is still a handful of weeks away. I suppose you could suggest there's some added risk for if we do pass this. Now there's more certainty that we are continuing to add to the debt here in the U.S.
Relative to our economy, the debt size, $36 trillion, is about 120% of the economy. So is that a sustainable level? People have been sounding alarm. Some consistent, some inconsistent, but it's kind of weird that the actual sect of the House is suddenly not budget conscious.
Yeah.
And this particular bill, as it stands in the Senate, which will get changed, adds about $4 trillion over 10 years to the debt.
Okay, so let's move to stocks. So what's the stock market signaling?
Sunshine and rainbows.
Sunshine and rainbows.
It is
right?
back to all-time, like within a hair of all-time highs.
Doesn't care about bonds.
Yeah, we had a little sell-off because Israel attacked Iran, and this was probably one of the largest attacks against Iran from Israel for the last 50 years. And oil prices spiked 8% today, so there is some uncertainty being baked back into the markets. But even after today, we're within a breadth of all-time highs. Tariffs are still on the table. Looks like there is some kind of a deal with China. Doesn't look like we're going to go below 30% tariffs, though. At least it's not 145, but 30% is a pretty hefty premium to import Chinese goods.
Wonder what carve-outs will be there, but
Yeah,
TBD, right?
correct. But these are all overhangs, right? That the stock market probably isn't fully pessimistic about. So that remains the question. Before the tariff sell-off in February, was the stock market underpriced, even though it was at an all-time high? Versus now, where it's almost at that point, but we have all these overhangs known. They're all known. So maybe that could be another component is, I think Chris and I have been saying, as long as we know what the tariffs are, we can move on. Yeah, I think we're seeing that, right? Consumer report, the consumer survey came out, big jump, because tariffs are in the rearview mirror for a lot of people.
So I think that I'll ask you to make a prediction. I think maybe we kind of just figured it out here, but the market might be waiting on the spending bill to pass, which is supposed to be done by July 4th. We're also supposed to announce a whole bunch of trade deals and whatnot. So then we can also get some certainty around tariffs, no tariffs, or just what tariffs are.
Correct.
And I wonder if it's those two things that are hanging out there, which are pretty big, right? Like those are kind of pretty big things. And once we can get past that, yields can then come down. So let me now frame that as a question and make you predict, live. So if we think we get the spending bill to pass, current status or otherwise, doesn't matter. But spending bill is passed, therefore we have certainty. And if also by July 4th, because that seems to be, I think it's like July 9th, but let's call it, early July.
Sure.
We get announcements on trade stuff so that we can all move past this kind of section of financial uncertainty at the country and trade level. Do you think rates go down if that happens?
Sure. Yeah, it could be the case where the bond market, when it diverges from this point, so the bond market is saying there's these risks, right? The stock market is saying, what risk? And that's hence the title, who's right or who's wrong. And it isn't Trump versus Elon, it's bonds versus stocks. So the bond market can very well say, you know what, we relent, we're going to accept 3.5% for 10 years, and then we could go on our merry way. But that would take demand, right? More buyers than sellers. Who's buying U.S. Treasuries when we're purposely increasing the debt, and we have all these tariffs that should slow down the consumer, which we'll get to, but you know what I mean? We're going to have less economic activity, which we're already seeing. Is there that might be a good time to buy bonds, not investment advice, but generally when there's a slowdown, rates do come down to spur growth again. So it's always fluid, but generally, historically, the bond market has been right when it does signal a risk. But the stock market is more fluid, if that makes sense. The stock market's always going to vacillate. Today's news was Israel, and tomorrow's news might be something else. Right.
Is the fact that bond rates are holding where they are signaling a risk?
Yes. So the bond rates where they are, the bond buyers are saying we're not going to buy more bonds unless, and especially if you're bringing rates down below 4%. Yep.
Anything else on that, or should we move to inflation?
Yeah, this move to inflation kind of plays off bonds, right?
Yeah, that's what I was thinking. So, all right. So CPI. So CPI is pretty muted. It's kind of right where we want it to be. So, just reading this quote here. So CPI for the U.S. in May rose by 0.1% from the previous month. By the way, that's not like that's normal. It's 0.1 times 12. It's not like the inflation rate moved by 0.1. It's the actual inflation is what that's saying. So
Correct.
Just
Yeah.
for context, that was lower than most forecasts. This brought the annual inflation rate to 2.4% for the 12 months ending May of 2025. The core CPI, which excludes the more volatile categories of food and energy, also increased by 0.1% with a year-over-year rise of 2.8. So we are at 2.4 and 2.8. That sounds pretty good.
That's great.
That's great.
So if we break it down, 2.4, gas and fuel prices have come down, right? Gasoline down 12%, fuel down 8.6%. That's mostly attributed to a pretty slow demand overseas as well, and then slowing demand here in the States. And that's why the Fed really doesn't look at CPI, especially with CPI with food and gas, because what do they do with rates? Yeah, and also they're not going to find a way to get people to spend less on gas. People are just going to consume the amount of gas that they consume, right? It doesn't change. And then the next category that was down significantly, airline fares, down negative 7.3%. But there's a slew of other categories that are up. Food up 2.9%. The biggest category of that group is meat, poultry, fish, and eggs, up 6.1. Sodas up 3.1. Juices, sodas and juices. Electricity up 4.5. Used cars and trucks up 1.8. Tobacco and smoking products up 6.3.
All right, let's move on. Whatever. Point is, it's good. It's good. Now, there's a prediction here, and it says UBS and JP Morgan economists project that core CPI inflation could reach 3.9% by the end of 2025, reflecting tariff pressures. So
that's a huge jump. Yeah.
That's a huge jump.
Yeah.
I'd be blown away if that happens. But this all puts the Fed in a pretty good predicament, right? Because like inflation is about where they want it to be. Well, they were revised, right? Because they said 2%, and they revised that. Are they? They're yeah.
I'm going to use scientific terms. 2% ish. So it could go 1.7. It could go 2.5, 2.6. As long as the averages kind of hover around the 2.0, that's what they mean by target.
Okay, so it's team bit high, but I mean, we're in range. We're not in scary mode anymore.
Yeah.
So, but then do they lower? I mean, that's the whole thing, right? I think they hold. I think they continue to hold, but I know that they're getting pressure to lower. This is not going to do anything to long-term rates, though, so it doesn't matter. I think they hold because, because of this risk of if there's tariff impact and it brings inflation back up, they're not going to want to lower and then go back up. That's a really bad look. So I think they just hold.
Correct. Which
you're in agreement.
I'm going to play Trump and say, well, you're crazy. Look at the inflation number. Just cut rates by a full percentage on your next meeting, which has never in the history of the Fed has never been done. So yeah, that's a big risk in terms of the face of 50% steel and aluminum tariffs that have been in effect for 12 days, right? That's probably one of the most consistent tariff rates was that steel and aluminum rate. It was 25. It got bumped up to 50. But what uses steel and aluminum?
Everything?
Like everything, yeah.
Yeah. So that went into place June 1, 2025.
Yeah.
Okay.
And the car prices is a bigger component just by sticker, right? In terms of the CPI measurement. So if you're raising car prices by, let's say the car maker's just passing along all those increased costs, and they, you know, raise prices by 30%, because it's not all steel, right? So they're just passing along whatever that particular input cost is. That's a big jump in just one sector. But if you look at washing machines and housing and really anything construction, that's going to be a big domino effect there.
All right. Well, we'll see. I guess we'll see what happens. Let's move to these stablecoin offerings. This is interesting. So payment stocks, I'm just going to read this here. So payment stocks, shares of payments companies dropped after Wall Street Journal reported Walmart and Amazon are considering issuing their own stablecoins in the U.S., which could overtake a high volume of transactions that are usually fulfilled using cash or credit cards via, you guessed it, Visa and MasterCard, and probably some American Express in there too. So Visa, MasterCard fell more than 5% each. Amex lost 2%, and Capital One retreated 1%. PayPal lost 4%, and Block was lower by 2%. So I think this is a nothing burger. This is not going to work. But what do you think?
Why wouldn't it work?
Because no one's going to do this. So you have to, if I'm going to buy something on Amazon, on my Amazon Prime credit card through Visa, and Visa is intermediary between my bank and Amazon, and they own the rails, they own that network. I'm going to have to get some really significant benefits. Significant, I guess 5%. I get 5% back on my Prime card, right? So if I have a credit card that's going to pull money straight from my bank account to sidestep Visa, it's going to have to give me at least 5% back. I just don't think that's going to happen.
Oh, so you're talking about the rewards infrastructure that's kind of been, for decades, right?
All about rewards. And the credit cards, as you know, they're designed for like the people that pay off their credit cards.
Correct.
Every month are the ones that are getting the benefits, and they're subsidized by the people that are paying, 25% interest on their credit cards. And so as long as you're paying off your credit cards every month, why wouldn't you spend in categories and get money back? And I don't know how that works. I don't know if that's a kickback from partially from like the retailer and others, but however it works, look,
it's money in your pocket by you just simply buying.
Exactly. Yeah. Exactly. And in the case of Amazon, because all of our money in our household goes to Amazon, it's a significant amount of money that comes back. So yeah, I think it's nothing burger. It's not going to work.
So what this is stablecoin is cryptocurrency, right? That's designed to be stable, right? And then in this case, one Amazon coin is equal $1.
Yep.
Because imagine buying Amazon with a Bitcoin, and it's we mentioned this before. Like one day you're incredibly rich, and then the next minute you're incredibly poor.
Yes, it's too volatile.
Not ideal. So stablecoin fixes that volatility, but it has to be backed one for one, so that for every stablecoin issued, an equivalent amount in fiat, meaning in this case dollars, needs to be kept in reserves. They could throw it in short-term treasuries or something other high yielding, but still, they have to. I don't know how much Amazon transacts, hundreds of billions of dollars every month.
A ton.
So they have to. They do have to get that much backing, which is through the customers buying, but then you lopped off the credit card incentive because I can't imagine anyone who has a Visa credit card, whether it's tied to Wells Fargo, Bank of America, whoever it is, it's that Visa channel that to me might be harder to overcome. Because if you think about it, Visa, MasterCard set up all this freeway system for payments that link banks to merchants to consumers. And I think rightfully the Amazon's trying to circumvent all this via digital currency. It's
because it's expensive, yeah.
Yeah, so it's, for me, it's like, it's uncovering what the whole promise of Bitcoin was, without the evangelicals behind Bitcoin. Even if this fails, I think there's like a worthwhile look at why Visa, MasterCard charge 1% to 3% to merchants who I'm sure pass those those costs on to credit card, or really all customers, right? And if Walmart and Amazon were able to be successful here, oh my gosh, if they save 2% on, I'm just averaging 2% on every transaction, it would be so insane. I doubt they're going to pass that on to customers
No,
or
they're
shareholders.
bring it to the bottom line.
Yeah, but I don't know. I don't know if it could be done because stable coins are such a new technology, and that the network, the freeway system that I described with Visa, just seems so impenetrable.
This type of thing happens it's like the doomsdayers, right? Every 18 months, there's a new doomsdayer story, right? So like how many times in history, how many times in the last year has there been something announced and then all the payments companies drop and then nothing happens, right? And like it happens all the time. Something's threatening their business and then nothing happens. And so I put this in that camp for me. I just think this doesn't get traction, and I think it goes nowhere. I think it's cool idea. But the percentage of Amazon retail transactions that go through a credit card, it's got to be 98%. It's got to be 98%. I mean, no one's paying cash, right? They're probably debiting. It's probably some debit. Maybe it's like 70 or 80% credit and then debit, but still runs.
Debit still via the Visa
exactly
backbone. Yeah,
it's still the same network. It's a little cheaper, I believe, than a credit transaction for the retailer, but it still runs through the same network. So it's like it's just hard to circumvent. I mean, the lucky part that Visa and MasterCard have is somehow they've managed to not like buy each other or even think about that. And so there's actually, two big players. And then there's also Amex. But like that's what's lucky for them. Whereas so much other technology, there's kind of one player and then that's like, okay, you guys are getting broken up.
Yeah. What about Square though? Or Chime? Was it Chime we were talking about?
Chime, but it all goes through. So Chime goes through Visa. You get a Chime debit card.
So you defeated the purpose of circumventing, right? Because that's
doesn't work.
Kind of like utility, right? We have SMUD, which is Sacramento's local utility. Mm-hmm. But guess what the backbone is? It's the PG&E network, which owns all of Northern California. But so if you're successful of kind of breaking away from PG&E, you have to use their grid, right? Mm-hmm. So that's kind of the way I think about Visa and MasterCard is, as much as you want to break away from that, you still have to tunnel through them, and they're still going to charge you like a access fee or whatever, a toll to even use their service. So, what was it? Square, Cash App, any of these you go to a vendor, right?
Toast,
and you swipe it on your phone. These. Yeah, it's all Visa still.
You're whipping out your Visa card and you're putting it through one of these apps, and so. Yeah, exactly. If you're Block and you own Square's all on Visa or MasterCard's backbone. They have to process this, or Amex. They have to process through those carriers. So I don't know how you get around that in a clean way, because the card thing is just so simple.
Correct.
And around the world too. It's not like it's a U.S. phenomenon. Like around the world,
it's Visa. Yeah.
Yeah, you tap, and interestingly when we were in. I think we mostly saw this in Paris, but mostly saw this in Paris. A lot of advertisements for Amex.
Really?
Yeah, and American Express, like you'd think it would have a lot of business in the U.S. because it's called American Express. I was interested or impressed to see how many buses drove by. And it said American Express, and it was, very much like, the card that international people hold or whatever. And it's probably a separate division, but I think they're definitely trying to break into the international market because it's, again, owned by Visa and MasterCard everywhere.
Yeah.
So,
well, how this would work if they were able to pull this off is if you're shopping on Amazon, it actually the price would look like it currently does now, right?
Mm-hmm.
It's just a matter of how you're paying. So if you're putting in it has to be a direct link to your bank account at this point, because I can't see a credit card approving this. But what would happen is Amazon basically would take your purchase and buy stablecoin with it, and then executes the processing. The benefits of it is like instant settlement, like within seconds versus hours or days.
Mm-hmm.
And I think from Amazon's point of view, zero interchange fee. I call it a toll. Apparently it's called interchange fee of that 1.5% to 3% that is charged by Visa and MasterCard.
Mm-hmm.
And then, but if Amazon were to pull it off, it would kind of make sense to kind of deploy the Amazon stablecoin to other retailers or anywhere else that would be looking to circumvent that credit card channel. But then to your point, our consumers willing to do this because we get 3% on our purchases,
Right.
And I think that's a big hit, especially if Amazon isn't willing to share savings.
That have to show up in the form of just like cash, coin credits, right? So saying distribution use cases, stablecoin can be used for customer purchases on their platforms, okay? Supplier and vendor payments, okay? Loyalty and rewards programs, so that means you get like a stablecoin rebate from Amazon, but that's not like, you'd have to be able to convert it back to cash.
Correct.
Which
You know what? Where I've seen this work, now that I'm thinking about it, it's said out loud. You got Arco AMPM by you guys?
Oh, yeah.
Or really any gas station, right? They post a cash price and
Yep.
a per gallon credit price.
Yep.
It's like 10 to 15 cents per gallon different.
Yep.
And that should incentivize you to use your ATM versus your or cash or ATM versus your debit card, right?
Yeah, that's a good example. Yeah.
So
you could see two prices now.
Yeah.
$19.99 or $18.99.
Yeah, if you use a credit card, right?
Mm-hmm.
Which will probably piss a lot of people off, but like that might, I'm sure they've talked about it, but like that might induce people to just say, hey, I'm going to forgo rewards on my credit card and link directly to my bank just so I could save X amount, right?
Both companies are waiting the outcome of the Genius Act, which would establish a federal framework for privately issued stablecoins in the U.S. Only after regulatory clarity is achieved are they likely to proceed with formal applications and launches. Interesting. Technology partnerships. Walmart and Amazon are evaluating technology partners and blockchain partners to issue and manage the stablecoin securely and efficiently. Genius Act.
And if it weren't that dual pricing scheme that I was talking about, what if Amazon says 2% cash back on your purchases if you use a stable coin?
Right. I mean, it's interesting. I think they would have to match. They would have to match at least.
As long as it's lower than that carriage fee that the Visa charges.
Yeah. Okay, this is Genius Act advanced significantly in the U.S. Senate on June 11th. That was a couple days ago. Voted 68-30.
Wow.
Moving the bill past amendment stage and setting up the final floor vote within days, which means the debate is now limited to 30 hours.
We're talking about U.S. Senate, so 68 to pass is like pretty overwhelming.
Genius Act has attracted bipartisan backing, with several Democrats joining Republicans to advance the bill. Interesting. Establishes federal regulatory framework for payment stablecoins, requiring issuers to be regulated entities, maintain one-to-one reserves, and comply with anti-money laundering. So basically applying banking regulations.
Yep.
The bill is viewed as a watershed moment for digital asset regulation in the U.S. and is expected to accelerate institutional and tech sector adoption of blockchain-based payments if enacted. The Senate is expected to hold a final vote within the next several days. If passed, it goes to the House. There you go.
Yeah. So to be fair, credit cards are actually doing something. They're lending money out. So they're taking some kind of financial risk there.
Right.
And to circumvent that is you can't have debt spending, which I don't think is very American. I don't I don't know how else to say it. We love our credit cards. Portion of us love our debt, and I don't know. I could see this working if it's set up correctly.
Mm-hmm.
And I think to circumvent the rewards, you can't go beyond the cost of what you're saving, right? So if you're saving 3%, you can't reward 3%. Like you defeated the purpose.
Yep, totally. All right. Well, I still think it goes nowhere, but prove me wrong. We'll see.
It is Amazon, so we'll see. Yeah, they have a lot of innovations.
And if they can figure it out, it's a huge number for them. Same with Walmart. So, yeah. Okay, cool. All right. Thanks, everybody, for tuning in today. We will catch you again next time.
All right. See ya. Thank you.